Good evening and welcome to tonight's ICANN Wednesday webinar. Tonight we are kicking off April as Financial Literacy Month with our Credit and Money Management for Students presentation. My name is Britannia Mori and I will be going through tonight's topic with you. If you have questions at any point, you can go ahead and use the chat and drop in your questions. And I will answer those questions as they come in. Let's get started. So when it comes to money management for students, especially in, middle school, high school age students, the biggest thing to help understand is that every financial decision that you make now will impact future financial decisions. Everything is connected, and forming good habits when you're young is the best way to create strong financial habits and then a strong financial future. So we're going to jump in right tonight and just talk about how money does impact every part of your life. So it influences all of your decisions. It's where you're going to live, what kind of car you drive, how you spend your free time, and even the job or career that you have. Every aspect of our life is impacted or influenced by money. What we want to spend, what we can spend, how much we make. So helping us make sure that those influences and those impacts work in our favor is where goal setting comes in. And that's really the beginning of money management, is setting personal goals for yourself so that you know where you are now and where you want to go. Now, financial goals can be large or small. And when you're young, it's good to start with small goals so that you can achieve them and form those good habits. And then as you grow older, you can make bigger goals. So a financial goal could be small, could be large. It could be simply, I want to go out to dinner tomorrow night or next week, and I know I need to have money to do that. It could be buying a new iPhone. It could be purchasing a used car in a year. It could be owning a home after college. They can be long-term and short-term. In fact, setting financial goals should be both long and short-term so that you are accomplishing things closer to now, so you feel like you're moving forward, but then you're also setting yourself up for further success by setting up goals for down the road. So how do we set financial goals? We have to do more than just think, this is what I want. We have to set up how to get there. So identify and write down specific goals. If there's a goal you want to achieve, write it down, make a plan, set yourself a deadline. When do I want to achieve this goal? What is a realistic goal for that? And then what's my action plan to make sure that I meet that deadline? And once you have your plan, start taking steps. What are the steps in my plan to get there? What do I have to do? And, we're all going to come up against moments where we feel like, oh, this isn't working. Don't give up. You got to take a moment, take the hard moment, and then take the next step, get back on your plan. Maybe it needs some revision. Maybe you have to adjust your deadline. Maybe you need to add some more action steps. But write down your goals, set yourself a deadline, come up with a plan, and then take steps to see that plan through. So some practice, it's really just this easy. Write down what your goal is, write down what you need to do to achieve it, and when's your deadline? What's your due date? So you can jot those down in your free time. Some people have a goal journal. Some people just have a little notebook they keep in their wallet or their purse that will remind you. Maybe it's something, a Post-it note on your bathroom mirror so you see it every day. When you develop a plan around a financial goal, things that you need to consider in that plan. What income do you have coming in, and what money is already going out towards other bills and expenses? And then how does all of that factor into your short and long-term goals? You can identify the things that you're spending money on that you need, and the things you're spending money on that you want, but maybe you don't absolutely need. So you have to look at, when you create a goal, especially one that is a financial goal, what money do you have coming in that you can put towards that goal, and what money is coming in but it's already earmarked to be spent on something else. This is the formation of your budget. What's coming in, what's going out, and you make plans around that. So a budget is a tool to control your finances. And control sometimes sounds like a bad thing, but when it comes to our money, the more control we have over our money, the more secure we are and the more flexible we actually become in the things that we want to buy and the choices that we get to make. So in this instance, control is a really good thing. A budget helps you stay out of financial trouble. If you have all of your income and expenses outlined and you have a budget set, you can plan ahead. You know what's coming. It keeps you out of running into trouble. It helps you know if you're spending too much. When you set a budget and you track your spending, then you're going to know when you've hit your budget, if you're going over budget, if you're under budget and have some extra money that you can either put towards savings or a fun night out or something like that. Budgets help us avoid impulse spending. Now, impulse spending is very common when you're at the store to go and for one specific thing, but then you see that end cap. Those are strategically placed so that you're standing there waiting in line and you're surrounded by little things that you have an impulse to buy, or a sale on the end of an aisle. Having a budget helps us say no to those things because it's not in our budget. We didn't plan to spend money on that, so we're going to say no. And then the budget, again, helps us achieve those financial and savings goals that we have planned. Also helps prepare for emergency situations. If you're saving and you have an emergency fund, that's another way of staying out of financial trouble. You've prepared if you have a flat tire or you need, something comes up where you have to spend money you didn't budget, but you have an emergency fund. That is what that fund is for. And then once you get older, if you take out student loans, it helps you manage those student loan obligations as well. So we're going to do a little activity, kind of an illustration of what a college student's budget might look like. So as you're looking at different choices that this student makes, we can evaluate whether those are good choices or not. So a budget worksheet, this is a simple example of a college student's budget. You can see at the top, there's monthly income, grants, work study, amount coming in from other sources like their parents, student loans, other. And then we have expenses, and these are just some traditional expense categories. You may use all of the categories, you may not, but you can see tuition and fee, room and board, books, meals, utilities, personal expenses, things like that, and so on. So we're going to look at some sample categories and some sample income and expenses and align those to that budget worksheet and see if the student, Leslie, in our example, is doing a good job. So under income, we have $450 of extra spending money from part-time campus work, and then $50 from her birthday. And for savings, Leslie has been taught by her father the importance of savings, so she puts away $15 every month from her income into her savings account. Under bills, she has $50 for her cell phone, $15 for art class supplies. Now you notice she charges $30 but only spends $15 during the month for her monthly payment. She pays $200 a month for her car expenses, which is her car payment, her gas, and her maintenance. And then she pays $20. She puts that away each month to cover the accrued interest on her unsubsidized student loans. And then under personal expenses, so you can see the difference between bills and personal expenses. Bills is something someone sends you that you have to pay, and a personal expense is money that you choose to spend for your own personal options. So she spends $100 a month eating out. She goes to dinner once a week with friends, and she has some groceries on hand at home in addition to her campus meal plan. She did a $30 trip to Walmart, a $30 shopping trip with friends, and she spent $50 on entertainment. And for entertainment, you can kind of see they took a study break and went to the movies. They did 3 nights at a coffee shop. She's got a Netflix subscription, and she's gone to a few basketball games and things. So where does all that go? So in the budget worksheet, you can see that we categorize our income and expenses and add those to each category. And then once we do that and we do the math, is the balance positive or negative? A good budget is positive. We want to have a balance left over. We can add more to our savings account, or it just, sits there and accrues interest. Breaking even is also okay. What we don't want is a negative balance, which is what we're showing here. So if you think about what changes could Leslie make to have a positive balance at the end of her month, and what other questions would you ask about her decision making? So you can kind of think about all the numbers you're seeing on the budget worksheet and think, what would you do differently in this instance? So just off the top of my head, some things that you want to think about. On the expenses, personal expenses, she's choosing to spend $100 a month on meals and groceries, even though she has an on-campus meal plan. So that's easily a category where she could choose to spend less. She doesn't need to eat out once a week, or she could spend less on groceries and really rely more on her campus meal plan, which she's already paying for. She spent $50 on entertainment. I'm not going to tell anyone they can't have their Netflix subscription, but maybe she went to an evening movie with friends and she could do a matinee and spend less on her movie ticket. Maybe she can look for on-campus activities or community activities that are free and reduce that entertainment budget a little bit. And then she went shopping a couple of different times, a trip to Walmart, trip for clothing. Shopping is fun, but if you're in the negative on your budget, then it's unnecessary. That's a want, not a need. So those are some areas that she could adjust in her budget to get a positive balance. It's important to understand when you're saving, why you're saving. First rule, pay yourself before you pay everyone else. Look at what you have coming in and take a certain amount every month off and put it in your savings account. There are lots of different ways to save. You can have a savings account. Once you accrue enough in your savings account, you can move it over into an investment and see a greater rate of return. And then eventually you want to save for retirement as well, so that when you reach a certain age, you can retire and have saved up over your work life enough to not have to work all the time. So an example of saving, paying yourself first means after you get your paycheck, it's the first thing that comes out of your income. So if you get paid, the recommendation for starters is 5% of your income should go towards savings. Now, many people, once they get into this habit, they move it up to 10%. There are some cultures that even save upwards of 50% of each paycheck goes straight into savings, so that they build up that emergency fund, and they always have savings, and then they use that for other things. In this case, if you make $29.50 a month, and after you pay your taxes, if you take 5% of that, you're putting $110 a month into your savings account, leaving you $2,100 for all of your other expenses. And it pays to start saving early. This is a great example of two different people. Emily is going to put $200 per month away in her savings account. That savings account has a 6% return, and she's going to start saving when she's 25 years old. Now, Dave is going to do the same thing, $200 a month at 6%, but he's not going to start until he's 35. So if they both add $200 a month every month until they're 65, but Emily starts doing it 10 years sooner, Emily will have contributed $96,000 to her savings account, and Dave will have contributed $72,000. But that rate of return, that extra 10 years that Emily was investing, her account balance after that full time from 25 to 65 is going to be twice that of what Dave had, and she, by saving 10 years sooner than he did, she will have $400,000 and he will only have $200,000. And they were both putting in the same amount of money at the same rate of return every single month. So it pays to start saving early, even if it's just a little bit in the beginning, and then you slowly build that up over time. It can really impact what you're able to do in the future. Another great way to save money and avoid overspending and blowing your budget is to avoid budget killers. Cutting back on small expenses doesn't seem like a lot when you're doing it in the moment, but if you add it up, it really does save big over time. Think about if you have food delivered. There's always an extra delivery fee if you're using Grubhub or DoorDash or Uber Eats or anything like that. It could cost you $2.50 to $7.50 a week, depending on how often you have that delivered and how much the delivery fee is. If you do that every week, you're looking at $130 to $390 a year just on having your food delivered. If you eat out once a week at $7 a meal, that's $364 a year that you're spending. If you go to an evening movie, which even now $10 is probably not as high as tickets are now, but let's just say you go to a movie once a week at $10 a ticket, that's $500 a year. Let's say you get your drinks out of a vending machine at $2 a pop. That's every single day you get one drink out of the vending machine. That's $730 a year. So let's say you have pizza delivered for $15 a week. That's $780 over a year. Let's say you go and get a coffee, gourmet coffee every day for $6. That's $2,100 a year that you're spending on a cup of coffee every day. And that's assuming you only do it once a day. One vending machine drink, one coffee a day. These things really do add up. So you can look at, maybe you cut back on certain things. Maybe you buy your vending machine drinks in bulk at the grocery store and you take one with you from home. That could be cheaper. Maybe you go pick up your pizza instead of having it delivered. That usually saves quite a bit on those delivery fees. Maybe you make coffee at home and only get coffee out once a week instead of every day. There are lots of things that you can consider, but what's important is to look at how you are spending your money and then do the math. Because $6 for a coffee in the moment doesn't seem like that much, but if you're doing that every single day and you suddenly realize, wow, what else could I have done with that $2,100 this year? I could have done a lot with that. So in terms of budgeting, it's the profitable strategies here to help you build success. Learn to use a budget, determine what you're spending your money on, and is it a want or is it a need? Live within your means, know what you have coming in, and make sure that you're living within what your income is. You're not stretching yourself. You're not constantly worried about money because you are responsible. You've set a budget, you've set goals, and you're following that. And then make saving money a habit. Habits, money saving is a habit. The more we do it, the more second nature it becomes. And then, yep, we're just, oh yeah, it's time to move that money over into my savings account. And then use your checking account to track your spending or use a budgeting app. But follow how you're spending your money, evaluate it, reflect on it, and say, is this what I want to do? Is this where I'm going? So that's our budget section. Now we're going to talk about paying for college, which I know not everyone is going to go to college and not everyone is going to even see the same expenses depending on what kind of college program they go into or education program. But we're going to use just a general example here tonight on what it looks like for paying for college and how you can use money management skills to try and go through college in the best, most responsible financial way possible. So there are lots of ways to pay for college: scholarships and grants, savings, again, that word. You can work your way through college. Sometimes parents will help. There are payment plans through the financial aid office that generally don't charge interest. You just break up your overall tuition bill over the 9 months of the school year and make monthly payments. Or as a last resort, there are student loans. Now, is education or training worth it if we have to talk about how we're going to pay for it and the rising cost of college? Yes, college can be expensive and costs are continuing to rise. But it does make a difference what your education or training level is in terms of your work potential, what your career might look like. And you do want a career. You don't just want a job. You want a career that you can grow with over the terms of your work life. So the poverty level right now in the United States for a family of 5 is $31,000 a year. The average that a high school graduate makes, according to the Bureau of Labor Statistics, is $30,000 a year. So coming out of high school with just your high school diploma, if then you get married and you have kids, like, you're making less than the poverty line for a family of 5. Now, will you immediately be a family of 5? No, of course not. But there are only 5% of jobs that you can get with a high school diploma that have promotional capabilities without further education. So it's a big risk to only have a high school diploma in today's workforce. Now, an associate's degree or an apprenticeship graduate through like a CTE program, their average income right now is $45,989. A bachelor's degree is around $52,000. Now that can be higher depending on these are averages. So it can be higher depending on what you studied and what the career path is that you're going into. Now, the average annual salary of a registered apprenticeship program graduate is $73,000 a year. If you have a master's degree right now, the average is $77,000 a year. A professional degree, so that would be like a bachelor's or master's plus 3 years. It's about $96,000, and a doctorate degree is $97,000 a year. So you can see that, yes, education is an investment in yourself, and it can pay off if it aligns with your career pathway, which is something that we talk about in our Exploring Careers presentation. and our career and college planning presentations is aligning your education and training with the career pathway that you want to go into. That's the best way to make good, sound financial decisions about whether you're going to college or not, what program you're pursuing, is to make sure that whatever you decide to pay works out based on the career area you're interested in. So let's look at average college costs for a year. So this is an average, let's say, state school, Regent University. So tuition, $7,800 a year, room and board, $8,100 a year. And then we have indirect costs, which are the things that the school isn't going to bill you for, but that average students will pay. So books and supplies, transportation, personal costs. It all adds up to about $20,000. Now, the direct costs are the only thing you get a bill for from the school. So the other things are negotiable. It's not that you won't have to pay them if you don't want to, but you have more of a choice in how much you're going to pay. Maybe you don't take a car to college, so transportation isn't an issue. Books and supplies, maybe you buy used instead of new. You have some flexibility there. Now, let's say for that $20,000, you're going to take out a student loan because you don't have it all in savings and you didn't get it all covered with grants and scholarships. Now, let's say that in these examples that we're going to go through here, you have three choices. Amount borrowed, you can see there's three options there. Now, we're going to say that you got about half of that $20,000 in scholarships and grants. So you need to cover the middle there. The $86.98 is what you need to cover for your loan. So you can commit to borrowing half of what you need, the $4,349, and you're going to commit to pay off the rest of it somehow, working, saving, whatever. Or you can borrow exactly what you need, the $8,698. Or you can borrow a cushion. You're going to borrow $10,000 because something might happen, something might come up. So each of those, you can see the monthly payment. Now, an interest rate of 5.5% with a repayment of 10 years, that's standard repayment for a student loan right now is 10 years. For the half you need, your monthly payment's $47, and you're going to pay back a total of $5,600 with interest. If you borrow exactly what you need, it's about $94 a month, and you're going to pay back $11,300 with interest. Now, let's say you borrow that cushion, that $10,000. Your monthly payment's $108 a month, and you're going to pay back a total of $13,000. So $3,000 more than you originally borrowed. Now, none of those three payments sound like a bad option. Even the $10,000 is only just over $100 a month. You can probably swing that. But this is the first year. And the thing you need to remember when you're planning for college and how you're going to pay for it and setting up your collegiate budget is that we pay for college 1 year at a time, but it's going to take more than 1 year in most cases to complete your degree or credential. So let's go with the average 4 years. So you're going to do statistics and studies always show that if you borrow money your first year, you're more than likely going to borrow at least that every other year that you're in school. So if we take each of those options times 4, now if we borrow half of what we need, we're looking at $17,396 for a monthly payment of $188 and a total paid back of $22,000. If we borrow exactly what we need every year, that's $34,000. We're going to have a monthly payment of $377, and we're going to pay back a total of $45,000 over 4 years for the 4-year loan. But if we give ourselves a cushion, we borrow $10,000 a year every year. Our monthly payment is now $400 a month, and we're paying back $12,000 more than we borrowed, $52,000. Now, can you, as a 17 or 18-year-old student, just going into college, fully commit to being able to pay $400 a month every month for 10 years when you don't know what the career market fully is, you don't have a job set up, you're borrowing on the basis of a career you think you're going into? Responsible borrowing is a little bit more than that. You need to understand what your limit is and set your responsible borrowing limit around what your intended career is. So how much are you going to borrow over the full 4 years? When you get to be a senior in high school and you apply for your first round of financial aid with the FAFSA form and with scholarships and everything you do with the school you're going to go to, they're going to give you financial aid for 1 year. And then when you're a freshman in college, you're going to apply again for your sophomore year, and then again for your junior year, and again for your senior year. But when you're a senior in high school, you need to do the math for the full 4 years. Or if you're going for a 2-year degree, for the full 2 years. But you need to do the math ahead of time and think, if it's costing me this much this first year, how much is it going to cost me for the full degree? You need to estimate then, if you're going to have to borrow, what your student loan payments are going to be. If you borrow $80,000, your payment's going to be around $800 a month for the 10 years after you graduate from college. Can you afford that? You shouldn't borrow, and this is where we connect your intended career pathway to your college education and training program. You shouldn't borrow more than your starting salary for the planned career that you're going into. This keeps your monthly payment around 10%. So if your starting salary is $25,000, you should not borrow more than, that's the 10% range, but really $25,000. Whatever your starting salary is, your estimated starting salary, not median salary, that's average, starting salary, that's your borrowing limit for responsible borrowing if you have to take out a student loan. And that caps your monthly payment. So if your starting salary is $25,000, your monthly payment's not going to be more than $180 to $280 a month. That's responsible. Now, if you can get it lower than that, that's great. But you don't want to over borrow and then be stuck with a large student loan payment that you can't afford when you graduate from college. So it's important to be a responsible borrower. Student loans should only be used for education costs. Student loans and credit cards, which we'll talk about here in our next section, should not support a college lifestyle. There's a reason why there are jokes about living like a college student, living on ramen, being poor in college. It's so that you're not poor when you graduate and have a career. Use your student loans if you have to as a last resort. Every dollar you borrow now has to be paid back later with interest. And there are other fees as well to taking out loans. So it's important to really understand when you take out a student loan what the terms and requirements are for that loan, how long you have to repay it, and what your monthly payment's going to be, and to estimate the full amount you're going to have to borrow to complete your full degree. So estimating those monthly payments, your monthly student loan payments should not exceed 8% of your income. Compare your estimated starting salary to your estimated monthly loan payments. And if the amount you plan to borrow exceeds 8%, then you need to look at some other options. You can talk with the financial aid office. You can consider other options to borrow less. Perhaps you need to consider a different school or program, but you need to make sure that you're responsible in your borrowing amount. So some profitable strategies around paying for college. Consider other ways of paying for college. Borrow only what you need. Know how much you can afford, and make sure you're estimating your total repayment amount. Now, it's not on my slide, but this is where I'm going to interject that I know that there's a lot of discussion about student loan forgiveness in the world right now. And I want to make it clear that even though there are programs that do forgive student loans, like the Public Service Student Loan Forgiveness Program, it's not a guarantee that those programs will always be there. It's not a guarantee that if you borrow a student loan, that eventually someone's going to forgive it. I think that there's some really irresponsible things going around that, oh, just borrow anything because they'll forgive it later. You don't have that guarantee. It's not written down in stone anywhere when you take out a student loan that, oh, someday someone might just forgive this and you don't have to pay it back. You should always go into borrowing for a student. Like if you're going to take out a student loan, you should always go into that knowing that you are going to be responsible for paying it back. So don't over borrow with the idea that it will be forgiven someday. There are very specific programs around public service or teaching grants, things like that, that may have a forgiveness component. But just in general, that should not be your plan, to just borrow whatever you need for college and then have it forgiven. Always expect to have to repay it. So our third segment on student money management, we're going to talk a little bit about credit cards. There are lots of credit card regulations around young people getting credit cards. Extending credit to a person under 21 is technically prohibited by law unless that individual can prove they have an independent means to repay the debt, or someone over the age of 21 has jointly co-signed that card. So a parent can co-sign and give their student, their child, a credit card, but there are some hoops to jump through if you're under 21 to getting a credit card, and that is to protect you from being taken advantage of by credit cards, by getting into too much debt when you're not fully ready to pay for those things like that. Now, if you are under 21, you are not also, there are not supposed to be any pre-screened offers coming to you unless you have signed up to receive them. And a card, if you do get a credit card under the age of 21, you are not allowed to raise your credit limit for anyone under 21 unless your co-signer has given permission. They also are required for everyone, not just those under 21, to have a minimum payment disclosure section on your credit card statement and on your online account that will include the total number of months it will take to pay off your entire balance if you only pay the minimum monthly payment. That's kind of always the big thing with credit cards is there's the balance, but you don't have to pay it in full. You can just make the minimum payment, but everything else accrues interest. So credit cards, I am not here tonight to tell you that credit cards are horrible. There are advantages to having credit cards, and there are also disadvantages. The advantages, they're very convenient. They're great in the case of an emergency. They build you a positive credit history. But the disadvantage is a credit card is a high interest loan. You are paying a very high interest to borrow money and pay it off later. So it does come with added expenses. Credit cards typically have fees attached to them in addition to the interest rate. And if you get too far into debt on a credit card and you're not able to pay it off or keep up with even your minimum monthly payments, that can have a negative impact on your credit. So this is an example of a credit card statement. Clearly, we have created this so as not to use a real statement from any credit card company, but it shows you the different sections that are required to be on a credit card statement. You're going to have the green section, which shows your credit limit and your available credit. The blue section is that required minimum payment section that's going to show you all the different amounts and things that could be paid in different ways. The red section is your transactions, and then your the purple section is your interest rate calculation. And we're going to go through each of these sections. So understanding your statement, the green statement, you're going to be shown your new balance, what your minimum payment is, and when the due date is. And then it's going to give you below that your credit limit, your available credit, your credit cash limit, and your available credit for cash. There are a lot of times with a credit card where you could use it like an ATM, but it has a different interest rate, and then it has different rules that apply to that. But you can see a balance of $2,000 and a minimum payment of $76 makes it seem like not such a bad deal. But then you get to the next section, understanding your minimum monthly payment chart. If you only make the minimum payment, it's going to take you 16 years and 10 months to pay off that balance, and you're going to pay $6,400. But if you pay, you know, a flat couple $100, $320 a month instead, it's going to take you 3 years, and you'll pay $3,000 total. And if we go back, we can see our balance was $2,000. So if we can't just pay the balance off, we only do the minimum, we're paying $4,400 more than what we've spent to borrow that $2,000. If we pay $300 a month, we're paying $1,000 more than we spent in interest, and we're done in 3 years. And this is if you don't make any other charges to that card. It's the $2,000, I never use it again. It takes me all of this time to pay it off. There's also in this section the late payment warning. Credit cards always have late fees. So in this case, if you don't pay by your due date, they will charge you $39 late fee, which is also then accrued with interest. And then if you're late, they could change your interest rate and make it go up. There's a penalty interest rate. In this case, you make a late payment, you get charged $39 for that late payment, and a penalty interest rate then goes up to 29.4%. So some examples. In example 1, you charge $750. The minimum monthly payment is $30. It's going to take you 32 months to pay at an 18% interest rate. So for the $750 you borrowed or paid or charged, you're going to pay back $947. In the second example, you charge $1,600. Again, your minimum payment is $30. It's going to take you 108 months or 9 years to pay back that $1,600, but you're actually going to pay back $3,200 because $1,600 is going to accrue in interest. Those are real examples. That's the math of a credit card. An average interest rate for a young person, 18 to 24%. So we're being kind in our example by using an 18% interest rate and flat monthly minimum payments. Now, what do these same amounts look like if we do a higher monthly payment? So in this case, we're going to pay $100 a month instead of $30. So that $750 balance is going to go down to 8 months, and we're only going to pay $51 in interest. Example 2, that $1,500, we're going to pay back in 19 months instead of 9 years, and we're still paying $240 in interest, but we're not paying $1,600 in interest. Now, again, these examples are one charge and we don't ever use that credit card again. That is not a likely scenario. Typically, people use it every month and that balance grows. So that interest just keeps accumulating. The best success strategy for managing credit cards is to pay it off in full every month. It builds positive credit history. You never pay any interest on what you're spending. And there's no worries about late fees or anything like that. If you can only pay the minimum, if that's what's in your budget, you will pay additional interest, and it's going to take a long time to pay off that debt. So profitable strategies on using credit cards. They do have advantages, but you have to remember it is a loan and it's a high interest loan. And there's a lot of problems that can come along with credit card debt if you don't use it responsibly. So understand all the terms and conditions of your credit card. Always pay the balance off in full. And the minute that you can't pay that balance off in full, stop using the card until you can, but always pay more than the minimum monthly payment, because the minimum monthly payment is designed so that you're not really paying very much on your principal, you're paying all interest. So it's just going to keep accruing. Use that credit card wisely. Think about it as a loan. When you use your credit card, would you go to the bank and ask for a loan to buy whatever it is you're buying with your credit card? Because that's what you're doing, but at a much higher interest rate. And then avoid those additional fees. When we say understand terms and conditions, what's the late fee on a card? Cash advances, we don't use your credit card as an ATM, because a cash advance typically has a much higher interest rate than you're charging. So you could pay 18% if you just use your card and charge something. But if you go and use your card as an ATM to get cash, you're looking at 25, 26, 28% interest on that cash advance. Try to avoid that. Don't do cash advance. There's also over the limit penalties. So you have a credit limit of, say, $3,000. If you charge and you've got $3,200 charged, you've overspent your limit. There's going to be a penalty on that, which is then going to increase your balance. And if you don't pay it enough to get it down, then you're going to start getting penalties on top of your penalties on top of your penalties. A good rule of thumb to avoid your over the limit penalty and to have a positive impact on your credit is to only use 20 to 30% of your credit limit. So if you are given $1,000 credit limit, you shouldn't spend or charge more than $200 or $300 so that you're not using up all of your credit. 20 to 30% of your credit limit is a strong strategy. Now, we've talked a lot about impact on credit. That's our next section on money management and credit. What is credit and what does having credit mean? So everyone has a credit report. It's like your report card for your financial trustworthiness. So everyone has a score, like a grade, and everyone has like a report card for their credit. And it tracks all the different ways that you use and spend money. So forms of credit, you can get a loan. You can have a credit card, a monthly account like a cell phone or utility bill, and then you've got your mortgage or your rent. All of those are forms of credit. And your report card or your credit report is a historical record of how you manage your credit. There are 3 major credit reporting agencies. They're listed there: Equifax, Experian, and TransUnion. They monitor everyone's credit. If you apply for a loan, it gets sent into the credit reporting agencies. When you apply for a loan, they're going to pull your credit report from these agencies to see if you're a good investment. Your report contains all of your personal information, every residence you've had, your payment information for every account you have open. Do you pay on time? Do you pay more than the minimum? What's your credit limit? What's your carried balance? What's your debt to credit ratio, which is that 20 to 30% is the recommended. They want to know, if we give you $1,000, how much of it do you spend, or are you conservative? That's going to tell you a record of how many inquiries into your credit. So how often do you apply for credit? And then it's public record information. So anything else that you might have hanging out, like past due, bankruptcies, anything like that is going to show up on your credit report and influence your credit score. Now, your credit score is your grade. Your report is all the information, and all of that information factors into a final grade or your credit score. Your credit score is a quick and consistent way for a lender to determine if you are a risk. It's based on everything that's on your report, and we call it a FICO score. It's the most widely used score. There are a couple other ones, but we'll focus on FICO tonight. Your FICO score can range anywhere from 300 to 850. The higher your score, the less risk you are to creditors. The lower your score, bigger risk. So what goes into your credit score? So 35% of your credit score is about your payment history. Do you make your payments on time? So the easiest way to raise your credit score is to make your payments on time. Every time you pay all your bills on time every month, it's a good thing on your credit rating. 30% is how much you owe. So when I said they might look at your debt to credit limit ratio, how much debt are you holding? And how much of a credit limit do you have versus the amount of debt that you have? So if you immediately, every time your credit limit goes up, if you immediately spend it, that's going to impact your score negatively, because you're constantly borrowing the money up to the limit that you're given. But if you can show that you may have a $5,000 limit, but you never go more than $1,200 or $1,500 on that limit, or you pay it off every month in full, those are going to show that you are less of a risk. You are responsible with the credit that you've been given. 15% of your credit score is the length of your credit history. So how long is your history? Because the longer your history is, the more patterns they can see in your behavior. So I still personally, I have my very first credit card from college. I use it once a year. It has a terrible interest rate, but I use it once or twice a year so that it stays open. I buy a tank of gas or something with it, and then I pay it off, because that means that my credit history goes all the way back to college. If you open a new account, there isn't that historical length there, so they can't look back and see what your history is. So new credit is 10%, because they want to know how often do you apply for new credit, how often are you adding more accounts. And then 10% is the types of credit used. So they don't, it's not recommended that you have, a whole bunch of credit cards. You want to have a mix in your credit. So conventional loan or a personal loan and a credit card. You might want to have a major credit card. You probably don't need 5 major credit cards. You want to avoid having a credit card for every store you shop at. That can actually hurt you. Store credit cards are frowned upon a little bit more by lenders than major credit cards for a couple of reasons. It shows that you're more likely to shop and spend more at those stores because you have a card specifically for that store. It also negatively can impact your automobile insurance rates simply because it shows that you're out and about more, shopping more. And sometimes that can be seen as negative in your credit score. So what is the impact of a credit score? So when you apply for a loan, they pull your credit. So this can influence if you have good credit or bad credit, that influences if you get the loan. It can influence how much you're given because it looks at how much debt you already have, your history of payment, what you can afford. It can impact your interest rate. If you have a high credit score, it shows that you are a good investment, less risk. You are probably going to get a lower interest rate. If you have a low credit score, you've missed some payments, or you just, you don't have a long credit history, you're probably going to end up with a higher interest rate. It can also impact whether you get an apartment or a job. There are lots of apartment buildings management companies that they want to pull credit when you apply for an apartment to make sure that you can pay the rent. Same with getting a job, especially if the job has something to do with finances or, trust in money management. They want to see, are you a credit risk? Should they trust you with their money? How are you doing with your own? So here's an example of a 5-year, we'll say it's a car payment or something. You're borrowing $27,000 for 5 years. If you have good credit, you might get a 7% interest rate. So your monthly payment's $500 and you're going to pay back $32,000. But if you have poor credit, you've made some unfortunate decisions and your credit rate is low, for that same $27,000 loan, you have an 18% interest rate. Your monthly payment is almost $700 and you're paying back $41,000 with interest. Can you afford a $700 a month payment over 5 years? What are you going to be doing in 5 years? Can you continue to afford this? And this is simply financial choices. The better your choices, the better your credit, the better opportunities you have. So good credit, good decision-making, good credit score, lower interest rate, lower monthly payment. You get to do more with the same amount of money because you're utilizing your decision-making for a positive. So how do you raise your credit score? How long will a negative item stay on your credit score? Who's looking at your credit score? What can lower your credit score? These are all good questions that you can reflect on when you pull your credit. What's going to raise your score? Number one, paying your bills on time. That was 35% of your credit score is made up of your payment history. If you pay everything on time every month, your credit score is going to go up. Not having too many open accounts is going to make your credit score go up. Paying things off, but in a responsible manner, going to make your credit score go up. If you get a credit limit increase, not immediately using it all, that's going to make your credit score go up. You want to have a good debt to credit ratio, meaning your credit limit, you don't want to use all of your credit limit. You want to have some debt to show that you're paying off your bills, but you don't want to have so much that it's completely used up all of your credit. If you do make some mistakes, you miss a payment or something like that, and you have a negative item on your credit report, it's going to stay on your credit report for 7 years. So for 7 years, that one missed payment is going to show up and it's going to ding you. The minute it falls off, your credit score is going to go up. Now imagine if you have a whole year where every month your payment is late. That's going to show a history and a habit of late payments. That's going to hurt your credit score. Now, bankruptcy stays on your credit report for 10 years. So that's a negative item that stays on the longest. Who's going to look at your credit score? We talked about this. Potential employers, if you're trying to rent or borrow, they might look at that for your apartment application. If you're applying for a loan for a car or a house, they're going to look at your credit. There's a lot of different people that look at credit scores to make decisions. And again, what can lower your credit score? Missing payments, over borrowing, too many accounts open, too many inquiries. If you run around and you're constantly applying for new loans or credit cards, and like every month there's an inquiry, that's going to show a pattern where you're constantly asking for more credit. If you do want to shop around for the best loan rate, do it all within like a week of each other. So go to 3 different banks all in the same week so that when your credit is pulled, it's all at the same time. It's not spread out over several months. So profitable strategies with regards to your credit. Pay your bills on time. Don't miss those payments. Keep your debt to a minimum. Avoid opening multiple credit cards. And leading right into our final section tonight, protect your identity. When it comes to identity theft, nearly 30% of identity theft victims are between the ages of 18 and 29. So youth are easily targeted because, one, you're not in the habit of checking your credit reports consistently, which you can do for free from each credit bureau once a month, or you can sign up for credit tracking. So Credit Karma does that for free. I know one of my credit cards tracks my credit score for free, so I get updates whenever I log in. It's just part of the free service there. You know, I pay for it in fees or something else somewhere else, but there are ways that you can constantly check your credit. But you do get a free report from each credit union once a year, or credit bureau, TransUnion, Experian, and Equifax. You can request your credit report from them once a year for free. So if you do it once from each one, like every 4 months you request one, you can get all 3 of them each year for free. It's important to do that because identity theft can happen, and the best way to see if that's happening is on your credit report. Identity theft affects millions of people every year, and it's going to cost you a lot of time and money to repair the damage and restore your identity. And it's not a flip of a switch. If you have your identity stolen, it takes a long time to get it fixed. So it's important to protect yourself before it happens, rather than try and fix it after it happens. I mean, you do fix it, but protect yourself up front. If you become a victim of identity theft, you need to file a report immediately with the police department. You need to contact your bank, contact your credit card companies, contact the credit reporting agencies. You need to basically tell everybody what's going on so they can shut down your accounts and start helping you reclaim your identity. Now, no one's going to do this for you. It's going to take a lot of work on your part. You report it to all of these people and they tell you the steps for their particular card or something. File a complaint with the Federal Trade Commission. And you, of course, have to contact Social Security Administration because you don't want anything happening with your Social Security number that isn't actually you. So you definitely want to follow that up. So those are your, there's lots of information under the financial aid section. There's a whole segment on money management that you can read more information on all the topics that we've talked about tonight. And there's tons of other things on our website that can help you as well. But I will leave you with these final profitable strategies with regards to your identity. Secure your mail. I know a lot of times we do so much online these days that a lot of times mail will just sit in your mailbox for a couple of days. Don't let that happen. Even if it's junk mail, bring it in, tear it in half, recycle it. Shred any personal information. If you get a credit card offer in the mail once you're over 21, hopefully you're not getting those under 21, but tear them in half, shred them so that someone else can't pick through your recycle bin and fill them out on your behalf. Never share your account numbers, and secure your computer. And I think what's more important than saying secure your computer, because almost everybody is on their phone now, if you're in public, don't be accessing anything to do with your bank account or your credit card statement on public Wi-Fi. There could be someone also on that public Wi-Fi that is hacking into your system while you're logged into something. So you should not be using your phone in public spaces to do any kind of financial anything with account numbers, with logins. It's just not safe. Always monitor your accounts. Again, looking at your credit scores, your credit reports, looking at your credit card, going through your transactions, going through your bank statement and making sure that all of the transactions are actually you. And watch for that suspicious activity. If you become a victim, immediately take action. Do not wait. The longer you wait, the more damage they can do. So in summary tonight, it is so important to start these habits when you're young, because the sooner you start, the more benefit you will see and the less likely you are to make those early mistakes that so many of us make in our 20s. So know your skills and start early. Set financial goals. Learn to use a budget. When you're ready for that college discussion, keep your student loan borrowing to a minimum. Remember to link it with your career's starting salary. Create a responsible budget. If you want to talk to someone at ICANN We do free advising around all of that information. We can sit down with you, go through your options, and help you create that budget and make informed decisions. When you do get to the point where you're going to have a credit card, make sure you understand how it works. Read through the terms, understand what the interest rate's going to be, understand when your payments are due, what your balance is, how payments work, how fees work. Don't go for the credit cards that charge you a fee every year just to have the card. Don't need to do that. And just overall, be careful with your credit. You have a blank slate right now, which means you don't have credit. You have to build up your score, but it also means you haven't made any mistakes yet. You don't have any bad marks on your credit. Start with that blank slate and keep it clean, keep it positive, make smart decisions so that as you build your credit, you're building it in a positive way. Yes, it takes time to get up into those 700 and 800 scores, but it can be done, and it can be done faster when you make good decisions. Protect your money, make good decisions with your money, set goals, and you will have a future full of more opportunity and options for you to choose from. So thank you for joining us tonight, or joining me tonight. Again, if you have any questions on the planning process for career or college, you want to talk about anything with one of our student success advisors, you can always go to our website, icansucceed.org. There's a button right in the middle that says schedule an appointment. You can meet with us in person, you can meet with us virtually, and we would be happy to help you go through your planning process. Thank you and have a great night.